I am so excited for all of you because I have packed this video full of value as we discuss the taxation of REITs, how it works, and how it impacts your tax return. That's coming up right now! I'm filming this video on March 15th of 2020, and you probably noticed, if you're alive and can fog up a mirror, that the stock market has been taking a beating. As an investor, you are thinking, instead of buying toilet paper, you're thinking of buying up this awesome cash flow producing assets at a discounted price. But with these cash flow producing assets, comes tax consequences, which is why we're going to discuss that today. And so whether you've already filed your tax return for 2019 or whether this video is going to help you out for the tax years going forward, stick around because I think it's going to be worth your time. So let's get into it. Whether you're new to investing or you're an experienced investor, you'll get used to seeing this statement known as a 1099-B. And basically a 1099-B, it comes in around February of the following year. So if you're for 2019, it would have came in 2020 for your 2019 taxes. And what the 1099-B does is it nicely summarizes your activity in that brokerage account for the year. So it's going to summarize your total dividends, your qualified dividends, your capital gain distributions, how much tax you had withheld, if any. It's going to summarize what kind of stocks you sold, whether it's short-term or long-term. All that stuff is going to be there all in one place so you can more easily file your tax returns.
Oh, that's kind of cool. It's almost as detailed as Mike's honeydew list that his wife gives him.
You should get one of these statements for every taxable brokerage account you have. If you have a Roth IRA or a retirement account, you're not going to be seeing a statement like this. It's only for taxable accounts. Right away, you can see that on this statement, I received in ordinary dividends on line 1A, $2,490.77 in ordinary dividends, and qualified dividends of $1,690.66. The important thing to understand about REITs is that they cannot give you qualified dividend income. Aww. And you want qualified dividend income because it's taxed at capital gain rates, which is a lower tax rate. But that it's not all bad news, because there's this thing now under the new tax laws that went into effect in 2018 known as a Section 199A dividend. So you still get some tax benefits from having REITs even when they're in a taxable account. Now, the thing I want you to understand, more so than anything, is where people get hung up and confused, is that on line 1A of $2,490.77, that is the total amount of dividends I received for the year. Whether they were ordinary and qualified, that is the total, is $2,490.77. It's not $2,490 plus $690. That's not how it works. So the way this reads is that of the $2,490 in dividends, of that amount, $1,690 of that what is going to get the qualified dividend treatment, which means it's going to be taxed at a lower tax rate than the other ordinary dividends. Does that make sense? On this page is further back in the statement, but you can see some of these transactions, the dividend payments throughout the year from these different companies, and you can kind of see how this works. So for example, Johnson & Johnson, which is not a REIT, was able to pay qualified dividends right here on these different dates. But I do have two REITs on this page, as you're going to see. So if you have REITs, this is probably what it's going to look like for you. Now, two of the REITs I own are health kind of oriented REITs, where National Health Investors is one of them. And you can see here the different payments, and you can see that they're marking them as Section 199A dividends, which I'm going to explain what that is here in just a second. And this Omega Healthcare Investors is also a REIT, and you can see the different payments there. And you can see that sometimes you're getting the dividends, sometimes it's a different kind of income, like a long-term capital gain, a non-recaptured 1250 gain, and so on and so forth, based on the activity of what's going on within that company. Now, what I would like to do is I would like to take you to the tax forms and show you actually how this impacts your taxes now that you have a general sense of what's going on here and how this works. I promise you that after you learn this information, your spouse is going to think you're so smart, they are no longer going to think it was a mistake to marry you. Now you can see we're back on the tax forms, and you're going to see how this impacts your taxes and really help you understand how investing and taxes are linked. especially in a taxable account. Now, Roth IRAs, if you have your investments in a Roth IRA, you don't have to worry about any of this. It's only the taxable accounts that are taking a beating tax-wise. Your Roth IRA is on a beach somewhere smoking a cigar and living the tax-free lifestyle like we all want to be. But we know we're limited, right? We're limited to how much we can put into those accounts, so that's why we have to funnel our additional funds into a taxable account to keep this thing growing, keep things moving. Even though we pay some tax, it's going to help us build our wealth sooner rather than later. Now, this tax form you might have seen in a previous video, like I mentioned, we're going to continue with the same amount of wages. We're not going to change that, okay? Because most of us earn a living through wages, and so we want to see how this plays out. You can see here that on line 3B, $2,491 is the amount of dividends that we saw right here. It's that amount right here, and you can see on the other line the qualified dividends coming through on line 3A. Okay, that's how we tell our tax form, okay, of this amount, this is going to be taxed at ordinary rates, but this amount over here, I want you to tax at qualified capital gain or qualified dividends or capital gain taxation rates, so you don't tax me as much, okay, taxes? And that's what we're telling the tax return by inputting this information here. And you're going to see $54 right here. Well, that is coming from some of the other items on the statement, which is on line 2A. That's where that money or that item flows to. But this video isn't really about how to prepare your taxes. This is more so to show you how this works. So let's get back into it. Okay, so what we see here is this raised Chipper's total income in this example from $53,000 plus his investment income, right? Plus the $54. So his total income now, before the standard deduction, before anything else applies, is $56,270. And that is his total adjusted gross income. But wait, there are adjustments against this that are going to help save you on taxes if this is you, if this is similar to your situation. The first one is the standard deduction. Now, if you're single, that standard deduction is going to be right around $12,200 for 2019. If you're married, it's going to be right around $12,400 if you're married filing joint. Maybe a little bit different if you're elderly or have other health issues or disabilities, and it might be a little bit higher, but for the most part, that's roughly where it's going to be based on your filing status. So what we're seeing now is we're seeing $56,270 in total income. We're going to back out Chipper's standard deduction. He's single. So now his total income right now for taxes is $44,070. But wait, there's more. Remember those Section 199A dividends that we were looking at? And you guys were like thinking, what the heck does that mean? Well, this is the part where I get to show you how this saves you on taxes. So in 2018, without going into a crazy amount of detail and boring you to death, is basically it's a business is now able to take a portion of its qualified business income and get a further tax deduction. And generally it's 20% of whatever the amount is. Now watch the magic here, watch the magic. So what we see is they're $598.72 times 20%. And it's ta-da, there's the $119.74, which you're seeing on the tax form. And what does this do to our taxes? Let's take a look. So Chipper had $56,270 in income. We backed out the standard deduction, and now we back out the qualified, the 199A dividends, which give us another $120 deductions. So what this is doing is it's reducing your taxable income by that amount. And so the taxable income now in this example is it went from $56,270, and with the standard deduction, and now with this 199A dividends, Chipper now has to pay tax on only $43,000 versus the $56,270 we saw above.
Fixed. Good.
Now remember me earlier telling you guys that you get to get a reduced tax rate on those dividends? Well, you do, and let me show you how that works. So there is a form, and I'm not going to go through the full calculation because I've already done it on the side. It would bore you guys to death, and it's overwhelming, to be honest. Let me flip to it. Now, in your tax software, when you're doing your taxes, you should be able to see a worksheet like this that helps you calculate the tax on your capital gain income. So we know that our capital gain income is the $1,691 plus the $54, right, from this statement. So this plus this. However, we get a deduction for this $2,755. And so on the form, you're going to see here that your capital gain income, though the income is subject to capital gains, is this plus this minus this. So remember this number right here, guys, 1,716.81. Just remember that for me. And let's go back to the form now, to the worksheet. And we go all the way down, and now you can see that number appearing right here. That's how they get to that number. And the total tax number is for capital gain taxes is based right here, is $1,017. Now, based on Chipper's total income, he's in the 15% bracket for his capital gains. So with this capital gain income, it's only going to get taxed at 15%. So this times 15% is $257.55. So that is the amount of tax that Chipper's paying on his capital gain related income, which is income. Capital gains are from sales or on recaptured gains and from qualified dividend income. And on the very next page of this worksheet, you can see the number right here. So that is the total amount of tax he's paying on his capital gain related investments, and that gets factored in to the total tax Chipper pays on his investments, which you can see that on page 2 of the 1040. So the total tax Chipper's paying is $5,406. There were some foreign taxes on his statement, so he gets a small tax credit, and those show up right here. See this line 8, this $5. So that there's an additional reduction in tax right there before foreign taxes. Thus, Chipper's total tax liability with wages and investments, in this case with REITs and everything, is $5,401. Now we know Chipper withheld from his paycheck in total for the year $4,679. So Chipper is now going to owe $722 when it comes time to file his taxes. When I did the initial video that shows just how to file a basic tax return with wages, Chipper was going to end up owing $315, okay? That's how much he was going to owe in that previous video. And then, let me unhide this, and you can see with the investment income. So with the investment income, you can see how this changes his tax situation. So he went from a total income of $53,725 to $56,270. You then see that the income was reduced with the qualified 199 or with a 199A dividends and the standard deduction. Total taxable income was $43,950. By Chipper now having investment income, his total tax increased from $4,994 to $5,406. So it's a $407 tax increase, but of that tax increase, $258 of that was based on capital gain related taxes, and only $149 of that tax was from ordinary taxes on his ordinary dividends, such as REITs and so on and so forth. So that's how it adds to one's taxes. That's how your investments will add to your overall tax liability for the year. And remember, the capital gain rate income is always going to be more favorably taxed. So that's the kind of income you want to receive as much as possible. Understanding that you're going to be taxed on this income is a huge advantage to you, and knowing this tax bill is coming, because most people are completely unaware of how this stuff works. So you'll be part of like the 1% who actually understands how this works now, because very few people in society do. So if you have let's say that your investments are increasing your taxes by $407. Well, to pay those, you can do one of two things. One, you can increase your withholdings, which you can do, so you can have a little bit more money withheld out of every paycheck, or you can make tax estimate payments. Either way will work. It doesn't matter. So let's say you get paid twice a week, which is basically 26 pay periods per year. To easily determine how much extra to withhold per check, what I would suggest you do, and this is just a rough example, is knowing that your investments are increasing your taxes by $407 per year, and that amount will continue to increase going forward. You might say, okay, well, I'm going to withhold an extra $500 per year for my investment income. So instead of 407, you say, well, I'll round it up to 500, so I'm covered. So take $500, divide that by 26 pay periods, and you basically want to increase your withholdings per pay period by about $19 to $20 per check. So that way, when it came time to file your taxes, your investment income would be covered, and you would have withheld enough from your income in order to not owe anything in addition, to the IRS. The other thing you can do is just make estimate payments. So you can make quarterly estimate payments on this income, or you can make, a one annual payment, whatever you want to do at some point during the year. So if you make quarterly estimate payments, I would just round this 407 up to 500 and divide that by 4. So every quarter, so like on April 15th, on June 15th, which isn't a quarter, but this is how the estimate payment periods work, 9/15, and by the end of the year, or by January 1st, or by January 15th of the following year, you'll want to make 4 equal payments of $125 to the IRS. I have several videos on how estimated tax payments work, so that is something you can do to cover yourself. But that is giving you guys the quick rundown, the quick lowdown on how this stuff works and how these investments impact your taxes. So REITs are great. I absolutely love them, and I love the cash flow. I love the flexibility it's going to be able to provide me and my family someday, and your family. But remember, do keep current with your taxes on these. As your wealth grows, these amounts will get larger and larger and larger. For a while, you might not even notice it because your current withholdings might cover it without you doing anything at the moment. But eventually, as your wealth grows, it's probably going to come to a tipping point where you need to withhold a little bit more or start making estimate payments. But remember, this is only for a taxable account. If you have your investments in a retirement account, such as an IRA, a Roth IRA, 401k, whatever, then you're not going to have to worry about any of this right now. I've always recommended in my other videos to make sure you're maxing out those other accounts first, because you want to invest as tax efficiently as possible at every chance you get. That's the video today, guys. Make sure you click the like button below to let me know if you enjoyed this, or leave a comment as well. I'd greatly appreciate it, hearing your feedback and thoughts around this subject of investing and taxation. Hope you have a great week, everybody. Stay safe out there. Make sure you have toilet paper, apparently. More so, make sure you have food and be ready to take advantage of these huge market drops and buy these cash flow producing investments at a steep discount. I love you all. Chipper and I will see you in the next video. Peace.